Gas has been the source of both the country's biggest boom and more recently its biggest crash. Australia's on the brink of becoming the world's biggest exporter of liquid petroleum gas, or LPG. But thanks to falling global gas prices, much of that gas is now being exported at a net loss, meaning very little tax for government coffers. As Matt Peacock reports, there are even questions about the viability of at least one coal seam gas facility.
Along Australia's east coast, the mining of coal seam gas has sparked angry protests. The hunt for coal seam gas has been fuelled by a $200 billion investment in the past decade, the country's biggest ever boom.
We're on the cusp of becoming the biggest gas or LNG exporter in the world.
$200 billion is a huge investment for an industry sector, absolutely huge.
But suddenly the boom has gone bust. The spot price for gas has dropped by 3/4, and soon the sums might not add up for at least one of these Queensland plants that liquefy coal seam gas.
The question is, can we actually get enough gas out of the ground, drill enough holes quickly enough and cheaply enough to feed those plants? The crash is a slow-moving train wreck, if you like. The price has dropped by 75%. That's a huge financial hit to the people that have made this investment.
It's not just investors losing. Australian taxpayers too are missing out on revenue.
There's very little tax being generated from the LNG boom.
The LNG boom began in northwestern Australia, with huge offshore deposits providing around 2/3 of our gas exports. Projects like North West Shelf, Gorgon and Pluto. But Monash University's Dr. Diane Cryo believes the new resource rental tax, originally designed for oil, has failed to deliver with gas. It's generating next to nothing.
In terms of revenue from tax, it's very minimal, and I would say at the end of the day Australians are still waiting for cash to come from these LNG projects for much needed infrastructure in Australia.
The boom in gas was fuelled by hungry Asian markets to our north, China, Korea and suddenly Japan. The 2011 tsunami shut down Japan's nuclear industry, spurring an urgent search for an alternative.
The Japanese were very distressed buyers of gas as an alternative source of electricity generation, and they were paying very high prices.
5 years on, Japan's cautiously reopening its nuclear facilities, and the Chinese economy has slowed. But Australian gas has been hit by another problem. The price of its long-term contracts is pegged to the price of oil. And in the past 6 months, due largely to Saudi Arabia, the oil price has crashed.
The drop in oil prices has really hit the economics of this project hard, as it's happening right when they're starting up and they're achieving some revenue.
These plants sell their product by long-term contract. It's pretty well understood those contracts are connected to oil prices, but there's also a cap and a floor, and they are closely guarded secrets. So we know that oil prices have halved, but we're not really sure what exactly is being received for the gas that's sold.
Hardest hit by the price drop are likely to be these operations on Curtis Island near Gladstone, fed by coal seam gas. Each one of these so-called trains, giant fridges that compress and liquefy the gas, have to be filled with gas sourced from hundreds of rigs across the east coast. At least one, believe analysts, may be closed.
The East Coast projects, they're the ones at potential risk from low prices of potentially running slightly below capacity or shutting into trains if the situation warrants it.
The CEO of one of the joint operators, Origin Energy's Grant King, concedes they're under pressure.
Overall, we still believe the project is robust, But again, there is no doubt it's the current oil prices and the low oil prices are very inconvenient. We're doing all of the things we can to reduce costs and to reduce capital outlays to make sure we get through this very difficult period.
Public opposition to the extraction of coal seam gas has added to the cost of current contracts. Origin, though, remains optimistic about its operations.
Will the second train be still coming online at the end of this year?
Yeah, sort of calendar year, early fourth quarter of the calendar year.
And will that be economic at the current rates?
So the second train, clearly yes, because it's a two-train project, and in a sense you can imagine that second train is quite incremental to all of the investment in the first train and all of the facilities that support it.
But with a growing gas glut worsened by cheaper US gas now entering the market, Australian producers look likely to be squeezed.
There might be a commitment to supply, but with periodic reviews of the prices, and you can expect a lot of pressure to come on the suppliers when those price review points come up.
Origin at least remains confident that oil prices will once again go up.
It's terribly inconvenient that oil prices are where they are at the moment, at a time that the industry, if you like, is at sort of peak funding. So it's terribly inconvenient that oil prices are level like that. But if you take that 20, 30 or 40-year view, I would not be an outlier, nor would anybody in the Australian industry be an outlier to say that oil prices will return somewhere to a sort of a more normal average level. And most people today would say maybe $70 to $80 a barrel.
The interesting thing is that at $50 a barrel, oil is actually round about its long-term average. The 40-year average price for oil is about $55 a barrel, actually, when you adjust for inflation. So the industry needs to get used to the prices that are prevailing at the moment, and somehow it's got to find a way of making itself viable at these oil price levels.
In the meantime, apart from the early construction jobs, Australia's unlikely to benefit under a tax regime that's failed to deliver.
The LNG boom is just another example of a country with a lot of mineral resources that unfortunately haven't been managed that well in terms of return to the community.
Matt Peacock with that report.